In the next few minutes, let's look at how to avoid or eliminate tax on your Social Security benefits. So, some people pay no tax on their Social Security income, and some people pay tax almost as much as their other income. So first, let's look at the rules, and then we'll see how you can either avoid or eliminate that tax. All right, so the rules are right on the IRS, the Social Security website. So it says for individuals, if your income is between $25,000 and $34,000, you'll pay tax on up to 50% of your Social Security income. If your income is more than $34,000, you can pay tax on up to 85% of your Social Security income. For married couples, the number's a little different. In this range, they'll pay tax on up to 50%, and if they're over $44,000, up to 85%. Now, when we talk about these income levels, this is not just the adjusted gross income on your tax return. Let's see how Social Security is defining income here. So they're defining income here as your adjusted gross income, which would be your interest, your dividends, pension, everything added together, plus any non-taxable interest. So even if you own some tax-free bonds or tax-free funds and get tax-free income, that income will continue to be tax-free, but it gets added for Social Security to determine how rich you are. So in calculating whether you should pay tax or not and how much on your Social Security income, your tax-exempt interest is added back to your other income. So they take that, add it, and then plus 1/2 of your Social Security benefits to come up with your combined income. And then these limits here are applied as we saw. Now, let's take a look at some examples of some cases and see how we can reduce or eliminate the income. There's tax on Social Security income. So first, let's take a married couple. Say they have $70,000 of income. Their scenario is this: they have dividends, interest, $10,000 each. Mary and John get $20,000 of Social Security income, and they have a pension of $10,000. If we add everything together, that's $70,000. Now, in their situation, they would pay tax. Their Social Security subject to tax would be $11,100 out of the $40,000. So only about half of their Social Security income is taxed. And we might, and they might say to me, hey, how do we eliminate that tax whatsoever? And I would tell them, don't bother. Why? Because their total federal tax is $333. So it makes no sense to try and mess around reducing or eliminating tax on their Social Security income, because their tax level is so low to begin with. Let's just forget about it. Okay. Now, what about if this couple has an income of $100,000? So let's just change the situation. Dividends and interest here will be $20,000 each. They each get $20,000 of Social Security and $20,000 pension. So their income, when you add it all up, is $100,000. Of that, $40,000 they get in Social Security income, $34,000, 85%, would be subject to tax. So their federal tax bill is $5,100. Now, if this married couple came to me and said, how do we reduce or eliminate tax on my Social Security income? I don't know that I would bother doing anything. Here's why. They have $100,000 income. Their federal tax is only like 5.1% of their total income. It's not a lot, but let's say they're insistent. They say, Larry, we got to do this. We hate paying tax on our Social Security income. And the husband says to me, I'm going to buy some tax-free bonds. Will that help me? And unfortunately, the answer is no, because here's scenario 2. Instead of this interest from taxable sources, like bonds or CDs or other sources, he decides to move that money into tax-free bonds so that that $20,000 is tax-free income. So now what happens when we add up their total income, the taxable portion of their income will only be 80,000 now. Why? Because out of the 100,000, 20,000 is tax exempt. But look at this. Social Security subject to tax is still 34,000. Why? Because Social Security / IRS include your tax exempt income when determining how much to tax your Social Security income. But their overall tax does fall almost in half. Why? Because he just converted $20,000 of taxable income to tax-free. So that certainly helped them, but it didn't help reduce the tax on their Social Security income. The husband says to me, I still want to reduce or eliminate tax on my Social Security income. What else can I do? Well, if instead of tax-free income, we made it tax-deferred, that would help. Now, tax-deferred income, a couple places you can get it, like I-bonds are popular right now because for this 6-month period, the interest rate is over 9%. It changes every 6 months. There's also a problem with I-bonds. A married couple can only buy so much, I think $25,000 a year. And in order to get $20,000 of tax-deferred income, you'd need something, you'd need $220,000 invested at 9%. So you can't even buy $220,000 of I-bonds. So let's say they just buy an annuity, which is a simple way to get tax-deferred income. So they put X amount of dollars into an annuity so that 20,000 of this tax-exempt income, or what was taxable over here, they're now going to make tax-deferred. All right, now what happens is Social Security subject to tax drops from 34,000 to 19,600. So we see there's a significant reduction of the Social Security income subject to tax, and their federal tax falls even further. In this scenario, it's $1,200 instead of $2,700. So they got an interesting result here in that by going from taxable to tax-free, they got some tax savings, but by going to tax-deferred, they got even more because of the reduction of taxes on their Social Security income. So this is almost bizarre when I say this, that here they pay less tax when the income is tax-deferred on an annual current basis than if the income is tax-free. Very odd situation because of the odd way that Social Security income is taxed. So these people, for all the years they're alive, if they keep this annuity, they will get a permanent reduction in the tax on their Social Security income. And let's just assume for a minute they die with that annuity. Their heirs would then pay the tax on the annuity, the accumulated tax on the income, and this escape from tax on their Social Security income would have been permanent. So even though the tax on the accumulated interest of the annuity will be taxable at some point, the escape from tax on their Social Security income will be permanent. Okay, now let's take a look at a couple that has a little bit higher income. This couple, 40,000 of dividends, 40,000 of interest. They each have 20,000 of Social Security and 40,000 of pension. Total that all up, it's 160,000. Their tax bill is $16,000 a year, and they're paying tax on 85%, the maximum rate, 85% of their Social Security income. If they move this money here that's taxable interest, 40,000, from taxable to tax-free, what happens? Does their tax bill go down? Ooh, you bet. That's a big drop from 16,000 to just about 6,000. Why? Because now they have $40,000 less income showing up on their tax return. But notice that still 85% of their Social Security income is subject to tax. What if they use the same idea as that previous couple and instead of tax-free, move that $40,000 to tax-deferred? Well, notice what happens. There's no difference in their federal income tax if they do that. And there's no difference in the taxation of their Social Security income because 34,000 of it is taxed here and 34,000 of it is taxed here. So what's our lesson here? Our lesson is this. For people with relatively modest incomes that are only paying a few $100s in tax a year, don't bother. Don't try and do anything because you're paying, almost no tax at all. For people in this middle range, say about 80,000 to 120,000, 130,000 of total income, that group of people, and now we're talking about married couples in our example, the same idea applies to single people, but at different income levels. So for people in this middle, married couples in this middle, say 80,000 to 130,000 or so, by moving income from taxable to tax deferred, they can drive down the tax on their Social Security income and, of course, their total federal tax. So it's for these people in this middle group, 80 to 130,000 or so, that they can actually engineer away or reduce the tax on Social Security income. Once somebody hits 150, 160,000, notice there's nothing he can do, because once he bought the tax-free bonds, going from tax-free to tax-deferred didn't help. So the lower people, they can't do anything, and once your income reaches 150, 160,000, you can't do anything. But in between those ranges, those are the people that have an opportunity to reduce or eliminate tax on their Social Security income by using tax-deferred income, primarily annuities, because there's no limit on how much money you can put in annuities. Next time, we're going to take a look at another way to slash your tax bill. See you next time on Retirement Crusaders.